would it be surprising to hear that the FASB, the accounting standard setters of the world, is made up of, historically, it's always 7 people. To come up with a new accounting standard, they only need a simple majority vote. A simple majority vote. You'd think that if you had 7 accountants in the room, if it's not unanimous, maybe we shouldn't do it. Well, the statement of cash flows is worse than earnings. I know you see research from the street saying, oh, I don't like earnings, I don't like what's happening. The statement of cash flows is more distorted. And these 3 FASB members at the time, the 3 dissenting votes of the 7, so they barely passed. Just one person had to swing over, and we would have had a different thing. But today we have the statement of cash flows. This is from 30 years ago. And here's what they said in print about the statement of cash flows. It's internally inconsistent. It doesn't make sense from the various buckets. It's misleading. This is 3 of the 7 FASB members at the time. It's confusing. People think it's a statement of cash flows when it really isn't. Now, to bring this again to a very specific example, pop quiz, where would you place interest expense in the cash flow statement? You don't have to see it. I'll give you the 3 buckets. It's either in operations, or investing, or the cost of financing your debt belongs in financing. What's the right answer? Accountants, don't say anything, please. Don't say anything. Now, I think the entire room would say financing. Under U.S. GAAP, that would be a misreporting in the financials, because every company, every U.S. lister is required to put interest expense under operations. It's ridiculous. Now, if you think of accountants as bankers, and you imagine that the bankers say, well, I'm in the business of borrowing money, I'm in the business of lending money, interest expense is operations. Yes, for that one of the 157 MSCI industry groups, that one group, interest expense belongs under operations. That makes sense. For everybody else, it makes absolutely no sense, and there it is sitting there. Well, it's not just interest expense. 2 companies rent. One company will put the rent under financing, the other one will shove it under operational cash flows. FedEx and UPS have totally incomparable statements of cash flows because of where rent gets placed. Perfectly legal. Neither company is doing something bad. I'm not attacking management. The attack is on the accounting rules themselves. Stock option expense. A Black-Scholes crazy formula-driven derivative calculation comes up with some crazy number that does not represent cash flow at all. They have a stock option expense number, and it's sitting in cash SG&A. Cash from operations is lower for every tech company that has a stock option expense that they've never spent a cash dollar on. In fact, if you think about it, a stock option expense doesn't mean the company spends money. When the investors, the new investors, exercise those options, cash actually comes into the company, not out, right? The cash flows are better from stock options, not worse, right? It's crazy. What else? Changes in capital. Changes in working capital don't show up under capital investment changes, or CapEx, which is, again, it's working capital. It's in the name, right? You would have thought it's in the right place. And pension expenses. Pension expense financing costs, not the cash contribution for a pension. Does this sound like I'm doing an accounting lesson? I apologize, right? Bear with me. I'll get to something that's an actionable item. The pension cash contribution is not what flows through the cash flow statement. It's the pension expense number driven by the actuarials that can go up and down by $200-300 million a year, flowing through cash from ops, not representing cash from ops. So, very specifically, these guys said, inaptly named, I think they're right, and their final comment was, likely to be misunderstood by most users of the financial statements. That was 30 years ago, and they have not changed the cash flow statements rule since. It's gotten worse, it hasn't gotten better. So, specific example, AMD. You know AMD? Chip maker, semiconductor maker, goes in computers, competes with Intel for what goes inside. Now, AMD, this was in Barrons in January of 2015, is the only time we've sent anything to Barrons, and they thankfully published this. It was a very simple idea. I'm not saying AMD is a great company. We're not saying it's going to overtake Intel. It was a very simple trade. The trade was AMD was priced for bankruptcy. It was selling for less than $2.50 a share. On anybody's metric, it said bankruptcy is in order. It was getting rated CCC by Moody's, S&P, and Fitch. The credit markets had it in bankruptcy, and there's a big reason for it. Cash from operations, as reported, was negative. Now, sitting in that cash from operations number as reported was 200 to 300 million, 200 to 300 million of pension expenses, 100 to 200 million of stock option expenses, and a whole bunch of other things. If we just take cash revenue minus cash cost of goods sold minus cash SG&A, the way the statement of cash flow should have been written, we would have seen not this, but what they reported in Barrons, over $1 billion in operating cash flow. Now, we're not saying it's a great company. We're saying they have a lot of money with which to service their debt. They probably won't go bankrupt. That was it. Not a great company. But think about, over the last 7, 8 years, buying a stock priced for bankruptcy that doesn't go bankrupt. Who cares about the quality of the company? Think about what the stock does. Let's see. MGM, price for bankruptcy, didn't go bankrupt, stock doubled. Las Vegas Sands, price for bankruptcy, did not go bankrupt, stock, I don't know, multiples. The airlines were priced for bankruptcy. 2010, those went up 40, 50, 60% in a quarter. As soon as people said, price for bankrupt, won't go bankrupt. The banks, when they were selling for less than $1 a share. You didn't have to know which one, you just buy 5 of them. If one goes under, fine. The other 4 went up 10, 15 times? 10 to 15 times? All right, it's not a bad trade. So our call was buy AMD, that was in there, because of the credit. Operating cash flow fell a little bit, still very strong, came back up a bit, and this stock last year crossed $15, up 600%. This is not a current investment. These credit-driven trades, you trade them, you don't invest. Right? Because as soon as the market, the momentum kicks in, they fly, and after that, I think it's actually down to 11 already. So I'm not recommending it, but it's the kind of trade that you can see by just simply having something better than what you see in S&P, Moody's, and Fitch for credit ratings, or from Wall Street.